Hello everyone. Just a quickly let me show you what I look at on my daily charts. This is my what I do in the evenings and make notes, and then this helps me to understand where we are when we're day trading in the context of the larger picture. A couple things I focus on are SAR levels, SAR zones, and I do use gaps, unfilled gaps as SAR zones. And here I have gaps, as you can see, marked using a triangle drawing. And this was the last gap that caused some resistance. Then we went through it. Normally, what you'll see is when gaps get filled, a lot of traders a lot of professional traders and retail traders will target, if they're long, will target unfilled gaps as the area will they'll exit. So a lot of times when gaps get filled and we sell off heavily, it's because that's what occurred. A lot of profit taking occurred for long. So if you see that, then you should understand that professionals just got out. If they do get out completely, they may look to get back in at another level, or if they just get out partially, the market should bounce back quickly again. So that's one of the things I looked at today. NQ and early in the morning filled that gap, and there was a lot of profit taking. We sold off. Let's quickly go over. Today was an interesting day, and if you're a type of trader that just looks at one instrument, probability of being shocked and awed was fairly high because you're expecting us to gap above a trading range and continue to move up. Instead, what the market does is sell off continuously. So, a couple of things that helped me were, first of all, we see volume breadth early in the day. We opened up very bullish, so a probability of gap up and trending higher was, just by looking at the volume breadth, was high probability. On the other hand, if you're looking at your other indicators, and this is the main reason why we have several indicators that we check the breadth of the market or the trend of the market, as soon as I see that volume index weight line, which is this pointed, this line here plotted by points, is red, and if it's red for the first 5, 6, 10 minutes, anything less than 15 minutes, and then it moves up and turns green, I'm okay with that. But when it stays red and it continuously moves down, that's a big alarm to me. And so when it happens on one instrument, take that with a grain of salt. When I see it in NQ as well, it's a big no. That's a big warning for me. So I'm getting divergences between two breadth indicators. So which one is right? Well, two ways you can handle situations like this. If you're new with these indicators and you haven't done your research, then you obviously don't know which one is correct. So you'll probably be like deer caught in headlights. If you want my if you want my knowledge on these indicators, since I've been using them for a long time, I'll tell you this: that if we're going to trend, the volume index weight will be green color. When it's red, it trumps the volume breadth. Another way that you could decipher this is by simply looking at another internal indicator. So for index traders, that's fairly easy. Look at the ticks. Are the ticks making lower lows or higher highs? What are they doing? So that'll be your icebreaker. If you're trading other instruments that don't have these kind of internals, then what you'll have to do is look at the price. Let's not forget price itself. Is price making higher highs or lower highs? That's one way you can do it. If you're using intermarket analysis, you're looking at other instruments that are similar to you, and they are also reinforcing that same analysis, then you know which one of the indicators is correct. Obviously, if you're trading other futures than the stock index futures, you won't be able to use the volume breadth because it's not available. It's an internal tool just for the stock index futures. So the main, and I've talked about this before, if we gap up and the volume index weight is red and stays red, we're going to fill that gap. Very high probability that we'll fill it. Doesn't mean that as soon as you see that, go ahead and short the market and put a stop above the swing high that you shorted, because it doesn't work like that. We can get a directional move and then fill the gap. But when you start seeing markets start to trend lower and lower, you get short, would pay for you to hold, and you get a nice run, or price moves away from you, you have some wiggle room, hold some of your position for that gap fill, and when they do happen, they don't happen every single day, but when that does happen, you can get paid nicely. Okay, the instrument to trade, and that's basically the tip of the day. Now, YM, if you're a trader just trading YM, both of these indicators would have fooled you. And this is the key point of looking at a couple of other instruments that are similar to your trading instrument, your main trading instrument, because by doing that, you see a broader picture. By just focusing on your instrument that you trade, you're going to have a tunnel vision, and most often that'll let you down and give you false analysis. Highly recommend that you guys, if you're serious about trading, to get used to watching a couple of instruments that are highly correlated with your instruments. For example, my main instruments for day trading are YM, ES, and Q. And YM is a really nice instrument because of the tick value. Uh, so I'm not saying that you shouldn't trade YM, but I watch all these three. I also, and for new traders, this is watching these three are fine. What I'm about to say is a little bit overkill for new traders because there'll probably be more work than value for them. But I also watch the Euro EC. I also watch crude and gold. I watch these three markets and the dollar index. So I watch those other futures because they do give me clues as to what's going on with major shifts that occur in the markets. So my main tips for you guys that are using our indicators is that always have the volume index and the volume breadth up for index futures, and also do look at your other instruments. Even if you're just an S&P trader, do look at YM, do look at NQ, and do the same analysis that you do on your main instrument on those as well, to have a good broad view of what's going on in the price action and markets, so you can be able to see these type of tricky days. The next thing that I want to talk about, but prior to doing that, so I just gave you a big tip on trend days, basically volume breadth. If you haven't done research with this indicator, volume breadth, when it's green like this, when it's above the 80% line and bright green like this, volume index weight does not support that. Odds of having a trend day are extremely low, so keep that in mind. The next thing, I just want to add one more since we're on the subject of trend days. When we gap up and the volume breadth shows you above 80% and very quickly comes down to 71% line, it'll put a low there. And that low, if that low holds, when it's retested again and price starts to move up again and volume breadth starts to move up and doesn't penetrate that low that it put in at around the 71% line, that'll happen usually. If it's green, that'll happen within the first 30 minutes to 60 minutes. That happens, then you are in good shape. High probability that market will make either a trend day going higher or a strong directional move higher prior to losing its strength. On the other hand, when it's green like this and stays green like that for the first hour, and then it starts to little by little move lower to the 71, and notice how it's just continuously coming down. This is extremely bearish, especially on huge gap days. What it's telling us is that the market is being shorted heavily. So it's very, and especially if volume indexes are supporting that same view, in other words, they're bearish. It's extremely bearish, so keep that in mind when you're analyzing your volume breadth. For those that were using our strategies, a lot of nice trades you could have caught. This huge move here. There was some nice trades here, and obviously if you're biased and if you're not biased and open to trading any of these the three sisters, NQ, it's quite obvious that NQ was the one to trade. Notice how as soon as we opened up, how bearish it was, and it remained bearish for pretty much the entire day. This was the instrument to short heavily if you were open to using either of them. The last thing I just want to point out is, and obviously you could have seen with the developing value area how the point of control continued to come lower and lower. Last thing, just to end on this note, is that for tomorrow's trading, just want to, don't go ahead and short this as soon as I tell you, as soon as it occurs, because I don't know what you're trading and how you're trading or what your stops are. But tomorrow, keep a very tight eye on point of control for Yes, point of control. Today's point of control is 11.1725. Keep an eye on that and see how price reacts to that. I believe that's going to be a key support area, key resistance area, or if we cut right through it or gap above it, then obviously it'll be a key support area. So that is going to be a key level to keep an eye on tomorrow, which is, again, for those of you who don't have market profile, it's 11.1725. That's the point of control for for today. It's going to be, I believe, relevant for tomorrow's trading. I hope everybody had a good day and good night.